let's be clear here that financial markets are not rational. There are no such thing as rational investors. But, there's some degree of things that we know that go on in the markets that drive the market. So on the other hand, markets aren't completely behavioral either, although there's a large part in markets going up and down that are behavioral as well. Joe, you mentioned before that often simple is the best thing, and it may not be very exciting. I learnt long ago that if an investment's exciting, you probably want to get out of it, real quickly. Investing shouldn't be exciting.
This week I sat down with Dr. Steve Garth. Steve is a principal of Principia Investment Consultants and is a member of our Stephan Independent Advisory Investment Committee. I invited Steve onto It's Never About Money because he brings a wealth of experience on how to invest prudently in the modern age. He has a rare combination of technical, research, and communication skills that have taken him to the top levels of academia, finance, and business. It's an absolute pleasure to have him on with us to talk about all things investment. Now, our discussion was absolutely brimming with value, so I've decided to share it all over 2 episodes of It's Never About Money. This is part 1, and I'll be sharing part 2 as our next episode. Make sure you listen to both so that you don't miss out on anything Steve has to say about investing. Enjoy part 1 with Dr. Steve Garth. Well, thanks for joining us, Steve. I'm really privileged to have you on. And just for full disclosure, this is Dr. Steve Garth, who runs his consultancy, Principia Investments, and he is actually part of the Stephan Independent Advisory Investment Committee. And I'm particularly excited to have Steve on to help discuss a little bit more about investments and the world that I certainly live in and that Steve is entrenched in. Thanks for coming on, Steve. I know that there's a lockdown now at the moment in Sydney. How are you faring?
Yeah, thanks, Joe. Hello to you, and thank you for inviting me onto your podcast. It's a real honour to be here. Yes, well, it's sort of I know you're in Melbourne, Joe, and this lockdown in Sydney is not exactly the same as what you're used to. It's what you might call a lockdown light. Some have called it the Clayton's lockdown. So while our Premier has, who all in all has done a pretty good job of managing the pandemic over the last 18 months. But she has told everyone that you can only leave the house for the usual 4 reasons. But oddly, all the shops are open. So if you need a new TV or, maybe a new pair of running shoes, apparently that's an essential service. And you can go to any shop and buy really whatever you want. Where I live in Manly, it's sort of a bit of a tourist destination, and no one from Manly actually shops in Manly because it's all set up for tourists. But sure enough, all the shops are open when I walk down the Corso, and you think, this is not a very good lockdown.
No. When you try to apply a rational approach and have a look at what's going on, it can make you a little crazy, I reckon. But well, I'm glad you're doing well, and I'm glad that we're distracting you with this podcast now. And I think it's pertinent to start with the question around your history and your background, because from your Bachelor of Arts with a major in history and politics, you've got a PhD in applied mathematics. You've picked up the saxophone as well. You've got many diverse interests, Steve. Can you give the listeners a bit of a story of how you came to setting up Principia Investment Consultants?
Yeah, okay, Joe. Stop me if we are still broadcasting into the middle of the night. But in a nutshell, I'm a Melbourne boy, born and raised, and formerly a Tigers supporter. Although apparently, should never say this, but I'm now a Sydney Swan supporter. I've been in Sydney for a long time.
Oh, well, you jumped ship.
I've jumped ship. Apparently, you're not allowed to do that.
No.
So I was born in Melbourne, grew up in Chelsea, down on the beach, which is odd because I'm sort of back on the beach here in Manly now. And I went to Monash University, which is where I started engineering, and actually didn't find that all that interesting. It didn't kind of work for me, engineering. And what I did find more interesting was mathematics, believe it or not. I know that's odd. And so I sort of migrated away from engineering more to a degree in mathematics. And from that, ended up doing a PhD at the Australian National University in Canberra in applied mathematics, but it was the applied mathematics of how light travels down optical fibres. So I'm sure all our listeners know what optical fibres are, and most suburbs are sort of wired up with optical fibres now. But back when I was doing my PhD back in the early 80s, it was all new, and it was actually a mathematical problem about how you get light to travel down a fibre and how you use that to communicate. I always remember my dad, who joined the Navy when he was 16 and ended up working with the Defence Department, and obviously, Dad more or less left school like he did back in those days when he was 14 or 15. And when I was doing my PhD, which of course he was incredibly proud of me, he said, "So, son, what are these optical fibres for?" And I said, "Dad, with an optical fibre, you can get 20,000 phone calls down a single line at the same time." He goes, "Son, who wants to make 20,000 phone calls?" And I thought that was always brought you back to reality when you're doing a PhD.
Yeah, keeps you humble, keeps you grounded.
So did the PhD and then came back to Melbourne and had what they call a postdoc at La Trobe University. And that was good fun. Did that for a couple of years. And in fact, it was while I was there, Joe, that, don't ask me why, but I did the Bachelor of Arts. I've always had a love of politics and history, and being a kind of a youngish man, I guess I was in my mid-20s then, I thought it'd be kind of cool to, for someone who's done a Bachelor of Science and then a PhD, kind of cool to explore my interests in history and politics a little bit more. So I've got a Bachelor of Arts there. Anyway, then I returned to Canberra after a couple of years, which is where I became a fully fledged academic, if you like, a tenured academic. And my wife, who's a Sydney girl, actually we met in Melbourne, oddly, but then she came to Canberra and both our daughters were born in Canberra. We were there for about 15 years, I think. And while I really enjoyed being an academic and, loved the work I was doing, I've always been interested in the markets as well, and interested in whether markets are completely behavioral or whether there's any science behind what goes on in financial markets. What do we know? What evidence is there around investing? And so that interest led me back in 2001 to leave academia and take a job as a portfolio manager for a US investment manager. And they were very much grounded in the work of a couple of academics. In fact, one of them now has a Nobel Prize, Gene Farmer. And these academics had created theories around what drives financial markets. What can we say with some degree of certainty around investment markets? So I guess it was a good fit for me, a firm that's more or less founded by a couple of academics, and it was a good fit for me to join. So I was there in that firm for 20 years until early last year. I decided to set up a consultancy to work with financial advisors and help on their investment committee, giving advice around investments and making sure that the clients of the financial advisors get really good outcomes in their investments.
So I'm looking at the bridge between your sort of academic career, the mathematical side as well, to the investment side. It sounds like really you were focused on finding something. The bridge was really evidence. Really, it was about evidence-based. It was about science. It was about your academic background that led you into a investment firm that was really using those as pillars, as a strengths of their investment approach.
I think that's absolutely right, Joe. I do remember when I was first interested in finance. So I had my PhD, and of course I had no money being a PhD student and then an academic. So of course, why wouldn't you be interested in finance when you've got no money? But I always, when I first started looking at it and started looking at the way, say an analyst might analyze a company, I looked at the number of assumptions that they were making, and I thought, I just can't see how these assumptions, which all seem reasonable, but I just can't see how that's going to pan out because we don't know what the future holds. always reminds me of a famous quote, which is that making predictions is really hard, particularly about the future. And when I looked at what, analysts do, and, analysts at the big broking houses, work really hard and do a good job, and they put everything they know, but it's only what they know now. And so I always looked at that and thought that's to me not really a good evidence-based way of investing, because you're making a stack of assumptions. And I always love listening to managers who pick stocks, and at the end of the year it hasn't worked out. And the reason why it hasn't worked out is they said, well, we didn't see that event coming. And it's like, well, no, of course you didn't see that event coming.
No one can see that event coming.
No one can. So I didn't, from that stage, I didn't have a lot of faith in the way that typical active or funds management was being done at the time. Mm-hmm. But as I learned more about it, I thought, look, there are some things that we do know about financial markets. Even though we can't say anything with absolute certainty, of course, there are sort of some long-term trends we can say. And so it's just my way of thinking about trying to apply an evidence-based approach to financial markets. Was a nice marriage with the firm I ended up working for.
So before we go any further, I think it would be remiss of me not to do this. I think, Steve, you and I know both that when you go on a Google search, when you've got a little bit of an ailment, you'll end up having cancer, according to Google, right? It's nonsensical to try to, sort of take the opinion of Google for your sickness. But when it comes to actual financial advice, we're actually sitting here talking about investment, and really it's general information. It's not personalized, and those listeners out there should use this as education, but actually fundamentally go and seek the advice of a financial advisor, investment advisor, when it comes to matters of huge importance.
Yeah, that's quite right, Joe. I should just say that I'm not licensed to give financial advice to end clients either.
But so, I am.
Yeah, you are. And I can tell you whatever I want, but I can't.
Yes,
I can't.
True.
To our listeners out there, I can't give any advice. And you're absolutely right, Joe. For, something I know that, we'll touch on later, the value of professional financial advice is just so important. It really is.
Yep. Now, I want to do a bit of myth busting here, Steve, because, in a way, your career is actually perpetuating a myth. And the myth is that, a successful investor needs to have a mathematics degree, needs to be, have an acute awareness of the micro detail of every single security out there. Do you think it requires your wealth of experience and a degree in mathematics to have a successful investment experience?
That is a great question, Joe. And the simple answer is that, as you correctly say, is a complete myth. A knowledge of mathematics does not make you a good investor. In fact, possibly makes you a really poor investor. So, when you look at my PhD in mathematics and even what I was doing at university, I understand how black holes work, and, I understand the unified field theory that Einstein did. But that does not help at all in understanding how markets work. And in fact, even though I've got this PhD and worked for a company that was based on academic ideas, the application of those ideas didn't require any mathematical, background as such. What is important is understanding what you might expect in the long term, understanding the micro details of a company rarely helps that to be a good investment. So, you're absolutely right. It's a bit of a myth that you need to understand mathematics. Often the best investors are those who understand least about the details, because they tend then not to go and play and touch and fiddle with their investments, and that more often than not leads to the best possible outcome.
Yeah, and those who seemingly have a successful journey often it's a simple journey. It's not something that requires a lot of complexity, and it's non-sexy. In some ways, it's very boring. What's not simple, in my estimation, correct me if I'm wrong here, Steve, but what's not simple is actually the human behavioral side of the investment approach. So maybe you can talk a little bit about that.
Yeah, that's absolutely right. And let's be clear here that financial markets are not rational. There are no such thing as rational investors. But, there's some degree of things that we know that go on in the markets that drive the market. So on the other hand, markets aren't completely behavioral either, although there's a large part in markets going up and down that are behavioral as well. Joe, you mentioned before that often simple is the best thing, and, it may not be very exciting. I learned long ago that if an investment's exciting, you probably want to get out of it, real quickly. Investing shouldn't be exciting. And perhaps later on, we'll touch on the difference between speculating and investing. Speculation, yeah, that's kind of exciting, but I'm not sure that's what you want to do with your wealth and the wealth that you want to pass down to your family and future generations. So investing should be boring. There's a great anecdote, Joe, when Donald Trump was running for president back in 2016. It's really hard to have a podcast still without mentioning Donald Trump.
We have to. It has to be.
I had to bring him in, but
yeah, absolutely.
Anyway, the anecdote goes that when he was running for president, he says, "I'm such a great businessman. I'm worth $9 billion." The fact is, Trump inherited $350 million from his father way back in 1975. Had he put that in the S&P 500, the US main stock market index, not touched it, reinvested the dividends, he would have been worth $13 billion. And you go, not sure how great a businessman you really are. You've kind of lost $4 billion along the way. But the point of that story, of course, is, and Trump has certainly had a spectacular and exciting business career. But the point of that story is that investing in the S&P 500, it's really boring. It's really dull. What are you telling me? I'm just going to put it in the stock market and reinvest the dividends? And the answer is, yeah, that was a really good investment. That was a really solid way.
Steve, let's follow this line, because I think it's really interesting. Anecdotally, of course, and based upon my experience, it seems like that the greater the quantum of wealth with some of the business owner families that I have often means that they're included and provided these exclusive opportunities, more investments, let's call them spicier, for want of a better term, investments that are out there. And it seemingly means with this additional choice, more mistakes are made. And often there is a confusing investment approach when you look at some of the investment portfolios that come across my desk, certainly. So it seems like that the greater the quantum of wealth, the more risks that present, and the less likely that there can be a successful wealth experience. Would you agree with what I'm suggesting?
Yeah, I think in general that can be true, Joe. It's certainly true that people who have set up businesses and been very successful in that and then have a bit of money become what you might term a sophisticated investor. And there's certainly then opportunities become open to them, such as private equity, alternative investments, hedge funds, which aren't typically open to the average or the normal investor. And so suddenly all this sounds great. Wow, I've got an opportunity to invest in, a hedge fund and you watch a show like Billions and you go, yeah, that's where I want to be, man. That's where the money is. And of course, the fact is that you're making something very complex and these investments don't always work out. When you look at hedge funds, for example, I'm sure our listeners sort of know basically what a hedge fund is. It is, unlike most fund managers, which are bound by the rules of ASIC or bound by the rules of SEC, hedge funds are sort of only available to sophisticated investors, and therefore they have a lot less rules about them. So they can do all sorts of things, go long, go short, buy into Bitcoin, do all sorts of things that your regular fund managers can't do. And so that sounds super. Wow, great. I'm now entitled to go into this more spicy investment. But when you look at the facts, when you look at the average of hedge funds, they actually underperform that broad index I talked about before. Now, unfortunately, when you get to the media, they only report on the hedge funds that are super successful, like Bobby Axelrod's, Billions TV show, if you viewers are familiar with that. And you go, it just seems money for jam. It's not actually that way in truth. So the trouble is you get having money, becoming what's called termed a sophisticated investor, gives you all sorts of opportunities. But those opportunities might seem attractive, and by seeming attractive, it's also got obviously inherent risks in there. And you're absolutely right, Joe. Without understanding what those risks are, can actually lead to a much poorer performance than, for instance, just putting the money in the index, which seemed really boring, but gives you a phenomenal return in the long run. So I agree with you. I always feel, Joe, that if you're a successful business person, and you're starting to accumulate wealth, by all means, keep doing what you're good at. What you're good at is building a business, and perhaps then, buy another business or invest in a business that you're really familiar with. But for a lot of your wealth, particularly the wealth that you're looking to pass down to the family and the future generations, if you don't understand, for instance, if you don't understand really what a hedge fund's doing or what this alternative investment is, you've just got someone trying to sell it to you because you've now got money and they want your money. Unless you understand it, then don't do it. And you're far better off putting your money into a very low cost, diversified pool of funds, which will give you the return of the capital markets. And Joe, just another anecdote from someone who's almost an icon to many investors, and that's Warren Buffett.
Yep.
And Warren Buffett has clearly amassed a huge fortune. He does buy companies, and he often uses leverage buyouts to buy companies, and then either breaks them up or improves them and on-sells them. And he's made an enormous amount of money out of that. But Warren Buffett has always said that I won't invest in anything I don't understand. And he avoided the dot-com boom back in early 2000 because he didn't understand it. It's not that he didn't understand the technology. He didn't understand the business case, how these companies were, how their stock price was going so high without making a profit. Where was the future revenue coming from? He always said, I just don't understand the value of these companies. And of course, he was proved to be right, because pretty soon everyone realized, I'm not sure what the value is either.
But Steve, you can also understand something like a hedge fund, but to choose not to go down that path. You can also understand what cryptocurrency is all about, but actually make a decision not to, because a lot of the time the issue is that whilst you might understand, the actual manager that is making these decisions has such a vast array of strategies that they can use at any one point in time, that it's that human being error that we're trying to avoid, and the emotion and the mistakes. And so therefore you can understand an investment and at the same time choose not to go down that route, don't you think?
Oh, absolutely. Look, that's absolutely right. Cryptocurrency is a great one, Joe, because it actually comes to a sort of a broader point, which I often make when speaking to investors. So here's the trouble with crypto. It's actually a great speculative stock. And it's speculative because I don't know what the expected return of cryptocurrency is. I can see what the historical return has been, but crypto, like any currency, it doesn't pay an income, it doesn't pay dividends, it doesn't have coupons, it doesn't pay rent. So when you think about stocks and bonds and property, there's something you get back from that investment. With crypto, you don't. So what that means is we're not clear what the expected return is. We can only look at the historical return. Now, after saying that, that's not to say that crypto isn't something that you might want to have on the side. And this is sort of my main point, which I'll probably come back to a few times. I think, when you're building a business and your energies go into that business, you want to have most of your wealth set aside that you're not focusing on, that's being looked after in a low-cost, diversified portfolio, and let the market work for you, let compound interest work for you. But, there will be, besides the energies you put into your own business, there will be stocks, individual stocks that you might want to buy. There will be a little bit of speculation you want to take with crypto. And I look at it as, having a little bit of money and going off to the casino on a Saturday night, and you have a certain amount of money that you're prepared to spend and have a nice time. And if something comes out of it, great. And if something doesn't, it was fun journey. And that to me is how you should look at speculative currencies like
that makes sense. But a lot of individuals, and not blaming them, because I think you could fall into this quite easily, don't understand what the side is. When you say I want a little bit on the side, what does that mean? Because effectively, when we put a little bit on the side, whatever a little bit means, we're effectively taking this money, moving it away from potentially some critical objectives that they need to meet. So to what extent should we have some money in crypto? Well, to the extent that you can afford to lose it all, in a sense, or have significant volatility. So, in that particular asset, and a lot of the cases, we don't have unlimited resources. And so therefore, I always think about, well, if you've got a business owner that needs to ensure that they feed their kids, that they're able to retire, that they're able to diversify away from their business so they feel financially secure, then, if they've got all of that capital to be able to do so, well, then fair enough, go for it, go the speculative route. But would you agree that it's this idea of what the side isn't really known to people as much as it maybe should be?
That's absolutely right. And you hit a really good point before, Joe. And if you're going to do something on the side, it's got to be what you're prepared to lose. And that's how I look at it. It's got to be what you're prepared to lose. So I can't tell you how much. Is it 10% of your money or 2% of your money or 1%? It's how much are you prepared to lose? And that's what a speculative investment is. It's how much you're prepared to lose. So for, a poor old former academic like me, $10 is about the limit, Joe. That's all I'm prepared to give away. But, the answer is going to be different for different people. But you're absolutely right. And once again, I think this is where professional advice from a financial advisor becomes so important, because you want most of your wealth sitting with the professional financial advisor that you don't touch. You let them look after it. You have a meeting once a year. It says, how are my investments going? And, if you're in a low cost diversified portfolio, they will say, we're doing great. We're doing really well. And it's that leftover bit that you can speculate with.
Obviously, in a very biased way, I completely agree. I'd take a step back from that. I'd say, a good financial advisor will allow you to understand what the side is.
Yes.
And that's fundamental to the investment decision-making process, because if you don't know how much to allocate to the side and how much is for critical, to meet the critical needs of your life, well, then what sort of investment approach do you actually have?
Yeah, that's it, Joe. And an earlier point we made too, Joe, is that investing should not be exciting. When you're investing for the future, that should be really, really boring. The more boring you can make it, the more hands-off you are, the better outcome you're going to get.
Yes.
So for whatever bit you want to play with, make it a small bit that you've got the interest to do it. If you've got zero interest in following, I don't know, Bitcoin, or following, Afterpay, or following, any individual stock, if you've got no interest in actually following that, just don't even bother. Just stay away from it.
Yeah. Now, as an investment professional, Steve, I know that, Principia Investments is all about, supporting financial advisors, facing the current climate. What do you think the biggest hurdle is for financial advisors at the moment, given the current climate, and how do you actually support advisors to meet this challenge?
Yeah, that's a great question, Joe. Perhaps I'll just go back a little bit, Joe. And the name of my firm is Principia Investment Consultants, and where that name comes from is, as a mathematician, this won't surprise you, one of the most famous books on mathematics ever written was the Principia Mathematica by Sir Isaac Newton, way back in the 1600s. And Principia Mathematica means the principles of mathematics, or the foundations of mathematics. So when I set up Principia Investment Consultants, it was all about, let's go back to what are the principles of investing, what are the foundations of investing. And to me, the very principles of investing are about looking to the long term, controlling what you can control, which are keeping costs low, having a diversified portfolio, making sure that you do pick up the sectors that are performing well, even though it will mean at times picking up the sectors that don't perform so well. So that's where the name comes from. It's what are the foundations of investment? Long-term, low-cost diversification. They're the foundations of investment. So when I work with financial advisors, and they've got a much more difficult role than I have. My role is to make sure that their end clients will receive these long-term returns that capital markets do provide and that compound interest will provide. Of course, the financial advisor, Joe, like yourself, has a much harder role in a way, because you've got to deal with the behavioral aspect of the end clients, if you like, the fear factor, because the clients out there are being bombarded by news stories about inflation's going up, inflation's going to go through the roof. If inflation goes higher, the stock market will fall over. Don't go into bonds because yields are going up and that's bad for bonds. And, don't go into this because, it's bad sector to go into, and don't go into, et cetera, et cetera, et cetera. So the media, of course, only wants to talk about sort of negative stories or fearful stories. If the media says everything is great, things are good, no one's going to read the story. So the media always focus on anything that sort of generates a bit of interest. So it's typically a negative story or a fearful story, and that I think financial advisors have to deal with most is the behavioral aspect of their clients worried about what the market holds. Now, at the moment, Joe, just sort of coming to your specific question about what's the biggest sort of fear, if you like, or the biggest issue that financial advisors are facing. To a large extent, on the one hand, it's got to do with the more low balance clients who are looking for income from their portfolios. And so the clients are asking their advisor, I need more income, particularly, people who are, I don't know, in their 70s and 80s are probably familiar with the glory days when interest rates were, 5 or 6%, and you'd leave your money in the bank and you get 5 or 6%. And now, you get 0.1% by leaving your money in the bank. And so this is a very difficult period for people of those low balance clients going, how do I get income? And the answer is, and this is where I admire financial advisors so much, because it's about, that education process of saying, look, in order to get more income means taking on more risk. Now, risk often is used in the wrong way. Risk often means you can lose your money. That's not what risk is. Risk really, in the way I use it when I'm talking about a diversified portfolio, risk is a greater volatility around your returns. So in other words, if you've got if you've typically had a lot of money in cash and cash is not earning anything, how do you want to have more income or more return? You need to be invested in a greater proportion of equities, because you're still going to get good dividend yields from that, and that will give you a total return. And of course, whatever income you need can come both from dividends and from capital gains.
But then, of course, the challenge for financial advisors is, as we move clients who may be very risk averse or not tolerant of risk, moving them away from cash and bonds, which are kind of very stable asset classes, into equities and property and so on. It means that the volatility of the portfolio, or the ups and downs, actually increase. And so therefore it's a balance between that at all times. And I think, correct me if I'm wrong, Steve, here, but one of the things that you're really trying to improve for financial advisors is their communication around investments, because the better the communication, the better the education, the more likely clients can actually digest.
I think that's right, Joe. And on that, word around risk, again, everyone uses the word risk return. Take on more risk, you get greater return. And in the end, for most end investors, they don't know what that word risk means. If you say this is risky, they go, whoa, I don't want to go anywhere near it, man. I don't want any risk.
Yeah.
But what you said is right, Joe. It just means that there might be more ups and downs and greater swings in the value of your money. Now, that is important. The older you get, that clearly is more important. But nonetheless, when you look at the long term of the stock market, you can draw an upwardly sloping line, as far back as you go. Yep, the stock market moves all over the place, but it's an upwardly sloping line. For most of us, the GFC back in 2008 was, the biggest event hitting the stock market. And yet, while that took 10 years to fully recover, it only took 10 years to fully recover if you had invested right bang at the peak. And then it took 10 years to get back to that peak. But for most investors that are actually invested, way before that, and, they probably recovered their money within 2 or 3 years in general, on average. The pandemic we've just seen through is even more so. Your superannuation funds, your investments sort of got back to where they were, I don't know, in just over a year, quite quickly. So it's this word risk that we all in our industry, we just throw out all the time. It's a risk return trade-off. If you want more return, you need greater risk. And I just think that a lot of clients don't understand the meaning of that word. What is risk to a client, Joe? It's losing all their money. That's a risk.
Yeah.
Catastrophic loss.
Complete capital loss.
Complete capital loss. That's a risk. But the fact that we just had a global pandemic and your investments went down by 40% in, March 2020, but it fully recovered pretty much by March 2021, that's not a risk, but boy, it's scary stuff. It's
scary. It's scary to the point that it's scary to the point that the client may actually agitate the idea that whilst there's been a temporary loss, that could be much worse. It could be a complete capital loss. And so,
absolutely.
And that's where the two intersect. The idea of ups and downs can actually agitate the idea that while there is a down in the market, that it could be a complete catastrophic capital loss.
Absolutely. It's a great, it's fully understandable. In my business, Joe, people ask me, what was your advice to your clients, my clients being, financial advisors, when the crash happened? And, my advice, and of course, all my clients feel the same. So it wasn't really advice. We just had a shared philosophy on this. When the stock market crashes like that, do nothing. Always the first thing to do in a sudden downturn is do nothing. Now, at what time do you do something? Probably the answer is never. Again, the GFC is a great example where the market kept falling by 40%. And, Joe, these are anecdotal stories, but unfortunately anecdotal, but true. So many people during the GFC, took their money out because they just couldn't take the fall any longer. And, the market did fall by 40%. It was really tough. I'm sure many of the listeners remember that period.
Yep.
And the market had dropped by 40% in August, September of 2008. And I think one of the big investment houses could have been the Bank of Scotland. Anyway, it's a firm that actually no longer exists anymore, came out in this big front page news on, I don't know, March 2009, saying market could still fall another 40%, sell everything. Now, why a big investment bank would broadcast that is beyond me, and probably why they're not in existence anymore. So they came out with this huge headline about markets to fall another 40%. If you're not in the market, if you're just an investor, or you're seeing a financial advisor and you've just been told that the market fall another 40%, of course you're going to panic. Of course you're going to ring up and go, I've got to get out now. So that headline came out on March the 8th. On March the 9th, the stock market went up by 5%. And nobody knows why, Joe. It just went up by 5%. Oh, boy, what a bit of relief.
Yep.
The next day, it went up by another 4%. The day after, it went up by, and everyone's just scratching their head going, what is going on? The market's going up.
And within a month,
it had recovered halfway.
Yeah.
Now, it did take a few years to get the rest of the way back. It doesn't matter. Pulling your money out on the way down was the worst thing you could do.
And once you miss out on that, right, Steve? Once you've missed out on that, that's not something you can just go back and turn back time and get back again. That recovery.
You can't get back again. You can't back again. You know, Joe, this is not a political comment, so I don't want Scott Morrison ringing me up and going, why did you say that? But, you know, I think all in all, you know, Australia has done an excellent job with the pandemic. You know, the vaccine rollout might be a bit slow, but, you know, basically, I think everyone would agree that, you know, the way we've handled the pandemic has been really good. There's one thing that I do disagree with, and to your point, it can't be undone, is that they allowed people to take $10,000 out of their superannuation.
Yep.
And this won't surprise, you know, your listeners, Joe, but it was typically the age group who were in their 20s and 30s who had the $10,000 in the super, but probably didn't even know it was there, didn't even know what super was until someone said, oh, you've got $10,000 you could take out. And the number of stories about people who took money out for tummy tucks and, you know, buying a car and all the wrong reasons.
Yeah, because 10,000 for a young person is not the same as 10,000 for an older person in terms of the time value of money.
It's the value of money. And of course, the other thing is, Joe, if you're a young person, you know, $10,000, you go, oh, well, I'll make this back by the time I'm 30. Again, you don't understand the power of compound interest. That $10,000, if you just leave it there, will turn into hundreds of thousands of dollars by the time you retire. The power of compounding, it really is one of the wonders of the world. And, you know, I've got two daughters who are 22 and 26. Fortunately, they didn't have enough money in super to even contemplate that. And, you know, I would have stopped them doing it. But one of the great things about the Australian superannuation system is most people don't know what it is. You know, they get a paycheck, and some of that paycheck that they don't see has gone off into this investment that they don't know anything about. And it sort of comes back to a point we made before, Joe, that the most powerful investment can often be the most simple one. The fact that this money is taken out of your hands before you get it and put away in an investment that you really don't have much idea unless you take an interest in it, that's incredibly powerful. It really is. And so suddenly when you retire, if you haven't touched your super and you've just been working for 40 odd years, that super pool is a nice pool of money. And I think the young people that they just don't realize the power that taking $10,000 out now has, particularly given with the pandemic, the market recovered so quickly. If you really took that money out back in, you know, February 2020, then that's money you can't get back. You know, it's not going to be easy to get back again.
Absolutely. I think you touched on a point before, Steve, that I really want to explore a little bit more. The idea that you said, you know, look, I think people need to be patient and hold their nerve and let the market do what it does. Now, that's predicated on the idea that where they are invested is sound to begin with. Thanks for listening to part 1 of our interview with Dr. Steve Garth. Keep an eye out for our next episode, where we will share part 2 coming real soon.
I hope that this one was enjoyable to listen to and there were some moments of value. If you have resonated in any way with the sentiments of this podcast, we would be delighted to direct you to our website, www.itsneveraboutmoney.com.au, for more free resources and education aimed at improving your capacity to make sound financial decisions for the benefit of your family. We wish you every success, however you define it.